the inflation rate is going to rise. It's going to rise quite a bit further. This is a situation which could begin to very rapidly deteriorate. And under those circumstances, I would not hold any equities, nor would I hold any fixed interest bonds. There is only one thing to do, and that is to try and get as much as you can out of the fiat currency paradigm and hold real money, which is metallic gold and silver. Then there will come a point, I believe, where in a general currency collapse, real asset values will detach themselves from the declining value of money. In other words, property, you'll see property prices stabilize at some stage and then rise. They will fall very heavily in gold terms because under those circumstances, real money will be only available at huge premiums because there's not a lot of it compared with all the currency that is being destroyed. We know that the Americans are anti-gold and pro-dollar, and good reasons why they should be, because they've promoted it to be the world's reserve currency. Everything is traded in dollars. They could no longer stick with even the sort of merest relationship between the dollar and gold, which is why the Bretton Woods thing ended in. So what we're talking about is a deterioration in the situation of the dollar, with the dollar collapsing under what is sort of commonly termed hyperinflation, but I think a better description is just complete loss of credibility and purchasing power. Under those circumstances, the only way they can stabilize it would be to go back to accept that really is gold, and they need to anchor the dollar to gold. Mm-hmm. I think it's quite possible that you might see the dollar go down to the point where they're considerably more than 50,000 to an ounce of gold. I really don't know. I mean, that is ahead of us, but there are going to be extreme difficulties, I think, for the Western fiat money establishment, fiat currency establishment, extreme difficulties for them to accept the reality of the situation. We face not only sharply rising prices as a result of the falling purchasing power of our currencies, but a falling GDP as well. Now, this is a lethal combination as far as the authorities are concerned, because this is reflected in rapidly increasing budget deficits, which have to be financed. There is a very important difference between money, legal money, which is only gold, and silver. In this modern world, we refer to legal money as gold. This is what J.P. Morgan said, before Congress in, I think it was 1912. He said, gold is money and all the rest is credit. And he wasn't stating an opinion, which people might think. He was actually stating a legal fact. And this is another thing where the cryptocurrency people, they just don't get it. A cryptocurrency is not money. There's no way it's money, and there is no way that it's going to replace gold. And not only that, but even gold and currency has a different position in law from a cryptocurrency backed up by a blockchain. Why? Because a cryptocurrency has the same position in criminal law as a work of art, your ownership of a property or whatever. If someone steals it off you, you can reclaim it without giving any compensation or whatever, because someone steals it from you, it is still your property. We are going to see higher government bond yields, and all fiat valuations take their cue from that. Everything from property, which basically the marginal financing or prices, the marginal price of property is based on the cost of finance in the form of mortgages. And if the mortgage rate goes up, property values go down. It's pretty simple. So I do see further substantial falls in stock markets, because not only are we not done with the rise in government bond yields around the world, but they are going to rise considerably further, and that's going to create even more difficulties for governments whose budget deficits are going to increase very substantially as a result of the contraction of bank credit. The volatility is not in gold, but it is in the currencies. But we can go one further and say, when you look at all these commodities, the volatility is not so much in the commodities themselves, though individual commodities will move against each other, but actually in the currencies. Now, the whole point about a medium of exchange, currency, is you've got to regard that in a transaction as having a value we can all agree on. So, if you want to sell me something and we can agree what an Australian dollar is in that. I mean, we're not going to dispute the Australian dollar, but we might argue the toss over, let's say, I don't know, a pair of shoes made out of kangaroo skin or whatever it might be. I'm just making something up. You might think it's worth more as a seller than I think it's worth as a buyer. And but we're always talking about, the constant in the transaction is not the value of the product, it is actually the money. Now, what those charts show actually is that when it comes to commodities in particular, the volatility, we should be thinking in terms of, we should be looking at it the other way around. Copper, for example, might say, how many tons of copper am I prepared to accept for these dollars? That's the way we should be looking at it. That's what this volatility is telling us. In other words, these paper currencies are not fit for purpose. They really are not. They are introducing volatility into everything. It is not the products which are volatile, it is the currencies themselves. And that is something that's going to destabilize them at some stage. And I think that's the very, very important point to understand. The only form of money which is stable, and this is why it is money, is physical gold. The rest of it is credit. Forget it. Credit goes up and down unless credit is sensibly anchored, credibly anchored to the value of gold. Then you have got a currency which is stable, but not unless. So this new settlement currency is actually potentially a huge deal if it actually comes into existence. The objective is basically to drive the dollar out of Asia, out of the countries which participate in it. They will no longer have to, sort of buy dollars in order to do a transaction from currency A into currency B, because the way it works is you sell currency A for dollars and then you sell dollars for currency B. So that the idea is basically to do away with that, because if you're going to get away from dollars, you've got to go get into something else. Well, what is that something else? Obviously, there's only one thing, and that's gold. So pricing it in gold, it comes back to the point that we've just discussed, and that is that if you want to see ultimate price stability, you price things in gold. And that indeed is what the chart reflects.